play.
You're short S&Ps, so would you short any of these individual names? Because theoretically, if you believe that the S&P is going to go down, then you believe that the momentum names will get sucked.
Absolutely.
Yeah.
So I would certainly short the garbage names. The other name that I was talking about last week was LinkedIn at 240. You could probably get rid of that. Now, if you get a bounce in LinkedIn up to 240, I'd use that as my stop and re-short it again. I think that gets hurt. Not a garbage company. I like the company, but I think it gets hurt in this environment, also from the Twitter IPO.
Well, the interesting thing about the LinkedIn action today is that now it's below the day that they issued all the equity.
Right.
So now it sort of made that round trip, because we did see LinkedIn stock rise on the back of the equity offering, seeming to defy expectations, and now it's back.
And we loved that stock for a long time, and Beeks hit the nail on the head. 240 was our sort of line in the sand. We talked about that a number of times, and you saw it sell off today on what was for LinkedIn a pretty heavy volume day. So to Beeks' point, 240 then becomes resistance. I think, and not that I like 200, I'm not a round number person, but for whatever reason, 200 was actually a level that gets interesting. So I think you look for it to trade down to 200 if you're so inclined to buy it there. And I think you may be able to ahead of earnings, which is October 29th. And your resistance on the upside now becomes 240.
I got to think Twitter traded off a lot today, even though it's private. I mean, yesterday it was frothy, talking about $20 billion. Yes, slammed.
All right. Let's go off the charts now on the big sell-off today. Did we do any technical damage? JC Perez is the founder and president of Eagle Bay Capital. JC, great to see you. And you're largely negative at this point, aren't you?
Yeah, and I don't think that it's anything that we should all be surprised about. The market's breadth has really been deteriorating for months. When you look at the list of, stocks and uptrends for a while now, they peaked in May. So as the market continues to make higher highs, less and less stocks are participating. Melissa, we've talked about this time and time again every time we're on the show. This is actually a chart here of the S&P 500. The first thing that stands out is this shaded area up here. This is the day that the FOMC came out with their announcement that they weren't going to do a taper, and that rally failed immediately after it came up. So the way I look at it is, sustainable rallies, do they begin with a failed breakout to a new all-time highs, or do monster failed breakouts start with a failed rally? And I think that's exactly what we're seeing here. So we broke through the 50-day moving average today, and I think that we're probably heading lower towards about that 1625 level. This is the breath that I was telling you about. So essentially the market needs an Altoid. It's had bad breath for about 4 months. With every new high in the S&P 500, we're seeing lower highs, lower highs, lower highs. That tells us that there's less participation. You guys were talking about the garbage stocks, the LinkedIns. You could throw the biotechs in there as well. The biotechs and the internet stocks were essentially the last men standing. And it's not a coincidence that those were the ones that were beaten up the most today. And I think that speaks to the point of that chart where there's just less and less good, right? So in this case, here's LinkedIn. This is just one example, but you can, you guys talked about a few of them. So here we go. This is the shaded area right here. When you see a consolidation after a big move in a name like LinkedIn, and you see these consolidations and it kind of taking a break, that's generally healthy, and you expect it to break out to the upside. Essentially, these consolidations tend to break out in the direction of the underlying trend. What we saw in LinkedIn, the exact opposite. It broke down, and I think that's terrible. And when you look at the momentum, it's been deteriorating the entire year. So I can't say that I'm surprised.
In terms of the S&P, JC, 1620 with 1625 you mentioned, where does it, though, break down? Where does this whole bull rally of the last 4 years, where's the technical level where things get really dicey? Because I don't think we're here yet.
Yeah, I think you're absolutely right. You mentioned 1620. I'm looking at 1625. And again, we like to draw our trend lines with crayons, not necessarily pencils. So to your point, yeah, 1620, 1625, I think that's the big level. That's actually also the 61.8% Fibonacci retracement from the June lows up to the August high. So that's a big level, number one. But I think that the big level that we really want to watch on a more secular basis is really those June lows, that 1560-ish area. I mean, that level better hold. And we're getting way ahead of ourselves at this point. We'll worry about that when time comes.
All right, JC, great to see you. Thanks for stopping by.
Thanks for having me.
JC.